Hey guys, welcome. In this video, I will discuss exchange traded funds or ETFs. We will also take a look at some examples of ETFs available on the market and deep dive into some of their features. Just before we continue, if you're new to investing, please make sure to first check out my video on Introduction to Investment Funds and also my video on mutual funds. A good portion of ETFs are passively managed, which means that they replicate a particular market index. However, you can also have actively managed ETFs with a dedicated fund manager. The major advantage of ETFs is their convenience. You can find ETFs to invest in many different things, like a group of companies in a particular geography based on market capitalization, or a particular sector or industry, stocks, bonds, commodities, real estate, etc. For sophisticated investors or active traders, there's even something called inverse ETFs, which allows investors to benefit from the decline of a particular benchmark or market index, or effectively shorting. There's also leveraged ETFs for investors looking to amplify their exposure and returns using borrowed money, debt, or derivatives. We'll keep things simple here, so I'll focus on index ETFs. Let's take a look at iShares, owned by BlackRock, which is one of the largest providers of ETFs. We are on iShares website. Let's click on products and view all iShares products. As you can see, iShares, they have over 800 funds available, so let's apply some filters. We want to look at ETFs, and in terms of investment style, I'm interested only in index ETFs, so we'll select that. Asset class, like I said before, you can have ETFs that invest in many different asset classes. In this case, I want to do only equity or stocks. However, here you can see that you have the option of investing in commodities or fixed income if you want bonds with fixed interest payments, and even real estate ETFs. But we'll stick to equity. You can also invest in sub-asset class, which basically is the size or market capitalization of the companies that the ETF is investing in. I'm gonna leave all the options unchecked. If you want, you can also focus on particular regions or markets. We're gonna also leave our options open here. Sustainability, this is another option that I'm gonna select. If you're looking to invest in companies that are sustainable and that are not involved in certain industries, for example, if you don't want companies that deal with tobacco, alcohol, adult industry, weapons, and some other controversial industries, you can select sustainable funds or sustainable ETFs, and those will be screened for you. So let's select that. Okay, and now we have here a list of ETFs that match our criteria. I will select here the key facts view. Okay, good stuff. Now, before looking into the ETFs, I am a long-term investor, so I'm only interested in funds that are accumulating. Okay, so that the distribution type is set to accumulating or accumulation funds. Remember, these are the ETFs that reinvest their dividends and buy more shares. So if you're a long-term investor, this is what you want to do because you want to benefit from that compounding effect over the years. Okay, so we will select only accumulating funds, and let's take a look here. So there are a lot of interesting names here. iShares allows you to compare up to 4 ETFs. So I'm going to select 4 that look interesting. This one, RBOT, Automation and Robotics ETF. Let's select that one. Okay, this one, Healthcare Innovation ETF, HEAL, sounds good. Let's select that one. There is one here for digitalization. Okay, that's pretty relevant these days. And lastly, let's see what else. Oh, this one, e-car, electric vehicles and driving technology. Let's select that one as well. Let's compare these 4 ETF we selected: automation and robotics, healthcare innovation, digitalization, and electric vehicles and driving technology. So as we can see here, the fund type, obviously all ETFs, asset class equity, sub-asset class all cap. Okay, so we're looking at emerging markets, developed markets, companies of all market caps. Here we have the investment objective. Okay, as we know, all these funds or ETFs are tracking the performance of an index. Okay, as you can see here in the investment objective. So the first one, the automation and robotics, tracks the performance of an index composed of developed and emerging markets companies which are generating revenues from specific sectors associated with the development of automation and robotic technology. Then the healthcare one is pretty much a similar description and objective, but it tracks a different index, so an index that is now associated with companies that generate revenue from medical treatment and technology. And we have the next one for digitalization, again similar description, but this one tracks companies that generate significant revenue from digitally focused services. And lastly, the electric vehicles and driving technology ETF tracks an index composed of companies that focus on electric vehicles and driving technologies. Okay, very similar description. They all track an index, and then what's changing here is that index tracks a different group of companies depending on how they generate their revenue. And here below we can see the name of the benchmark index that these 4 ETFs are tracking. They are all from the same index provider, if you will, STOXX or stocks. If we keep scrolling down, again very important, the use of income and is all accumulating as we know, and then the ongoing charges or expense ratio. We can see that all these 4 indexes have an expense or ongoing charge of 0.40%. If you saw my other video on mutual funds, the fund that I selected was the S&P Total Market Index Fund, which had a 0.1% of ongoing charges. Typically, you'll see that with funds or ETFs, mutual funds that are more niche or specialized in particular sectors, particular areas that are more unique, the expense or ongoing charge percentage will be slightly higher than those that track a generic index like the S&P 500 or the S&P Total Market Index or FTSE 100, etc. Still, 0.4% is not that bad at all, as long as you keep your ongoing charges or expense ratios below 0.5%, more or less. You should be good to go. Great. So we can see that the product structure, all physical. This just means that all these ETFs actually hold real shares underneath. Something that is very important to look at is obviously the performance, and more particularly the cumulative performance. So let's look at that. Here we can see the different performance figures. So if we look at, for example, the year-to-date performance, we can see that the e-car ETF or electric vehicles and driving technology ETF is the one with the best performance year to date. And if we look at, for example, the 1 year performance, this one is also as well the one with the best performance. Now, since inception, we'll see that the performance varies, right? 61% for eCar, 110% for HEAL, 160% for RBOT. Now, the caveat here is that the inception date might be different for these funds. A fund that has been around for 5 years, 10 years will have obviously a better cumulative performance since the inception. So do look at the inception date when looking at the cumulative performance. Now, if we look at the top 10 holdings, so these are the underlying stocks or underlying companies that these ETFs are investing in. It is important to understand the breakdown of the underlying securities held by these ETFs, just like with the mutual fund examples we did in the other video. The reason being is that you want to make sure that you are diversifying properly. So in terms of the top 10 holdings, it looks like there is not that much overlap among these 4 ETFs. However, we can see here that, for example, for eCar, for the eCar ETF, NVIDIA Corp is actually the #1 holding in terms of weight or percentage. And we can see also that the automation and robotics ETF or RBOT also has NVIDIA, but in the 3rd position with a weight of roughly 2%. So this is important to know, because if I'm going to invest in the electric vehicles ETF and the iShares automation and robotics ETF, then I'm slightly more exposed to movements in the NVIDIA stock. However, it's only 2% of the fund, so it's not bad at all, right? It's fairly minimized, but still. Then if you have other funds, or maybe if you invest in NVIDIA, then you'll know that, hey, maybe you like NVIDIA, so you don't mind being overexposed, but at the same time, you want to make sure that you're diversifying properly. The same goes with other examples here. For example, Tesla is obviously a pretty important company in the electric vehicles industry. But if you are already investing in Tesla, then, well, investing in funds that also hold Tesla maybe doesn't make a lot of sense. It is important to understand as well the geography or geographical breakdown of your ETFs. As you can see, a lot of ETFs have pretty fancy or catchy names, right? They sound pretty cool. Automation and robotics, healthcare innovation, electric vehicles, right? So obviously you want to maximize your investment. You invest in a lot of ETFs. However, if you don't look at the underlying stocks or origin of those companies that those ETFs are investing in, you could then realize that you are overexposed to a particular geography. In this case, these 4 ETFs, except for the electric vehicles one, are actually a bit overexposed to the US. So more than 50-60% of the holdings are in the US. And then in number 2, we have Japan, right? And then Germany, China, and others. So I'm not saying this is good or bad. I'm just highlighting that you need to understand the exposure that these ETFs bring to the table, so that you know whether you are meeting your investment goals and objectives. Let's say that I am very passionate about the electric vehicle industry. I feel that in the next 10 years, 15 years, there's going to be a boom in electric vehicle adoption. So I want to look more closely at the eCar ETF. I'm going to click on this. Okay, here we have the page for the electric vehicles and driving technology, ETF or eCar. Here on the top right, we have the prospectus and other documents. Please make sure you are checking those before investing your money in the ETF. Here we have the NAV per share, and you can see here that there is a 52-week low and high range. Remember that, as I explained in the Introduction to Investment Funds video, unlike mutual funds, ETFs they trade like shares on the open market. So you will see fluctuations in the price during trading hours. Okay, here we have the why ECAR, or the investment objective for this ETF. So it looks to invest in this growth trend of electric vehicles. It not only invests in auto manufacturers, but it also invests in upstream companies that supply technology and products, components to these auto manufacturers as well. So if we look at the performance, let's look at the cumulative performance. As we saw in the previous page, this fund has not been around for that long, so we don't even have a 3-year performance. However, the cumulative performance since the creation of this ETF has been 61% roughly. And remember the usual disclaimer, past performance is not an indication of future performance. If you believe in the electric vehicle or electric car technology, and you believe that we will see a lot of growth in this industry in the next 10, 15, 20 years as a result of electric vehicle adoption, then that should be your primary reason for investing in this ETF. Okay, we have here the key facts. So the net assets held by this fund, roughly 690 million in stocks of these electric vehicle companies. Here we have the fund launch date or inception date, which is the 20th of February in 2019. So it's fairly recent, fairly new. Asset class equity, the charges. And here we have the benchmark index, the stocks global electric vehicles and driving technology index. So we can actually look this up. Okay, here it is. This is the official index that this ETF is tracking, the stocks global electric vehicle and driving technology index. And we can scroll down here, go to max, and we see that, yeah, it looks like this index was launched back in 2012, and we can see here the performance over the last 10 years, and there's been some ups and downs, but overall the average trend is positive, so it keeps going up on average. Obviously we have here the dip of the pandemic, but overall we can see that the performance of this index has been fairly positive. And obviously if the trend continues and there's more electric vehicle adoption, and the companies, the car manufacturers, the auto manufacturers, and the other suppliers continue to innovate and bring new products that people and different countries and markets can adopt, then we'll see that trend, that increase in performance continue. So here we can see the portfolio characteristics. There are 84,500,000 shares outstanding. Also the number of holdings or companies in this fund is 89. See the individual holdings. We saw previously the top 10. Now let's click on show all and look at all of them. So here you can see a lot of familiar names as well in the auto manufacturing industry: Kia, Ford, Hyundai, Honda, Toyota, General Motors, Daimler or Mercedes, Nissan, BMW, Volvo, Renault, and many others. If I keep scrolling down, you can see here the listings, where basically we have the exchanges that list this ETF in particular. So for example, here in the UK, I can trade this ETF on the London Stock Exchange or the LSE. Okay, great. One final step. How can we buy this ETF? As we just saw, this ETF is listed on 5 different exchanges. And the reason for that is that you cannot buy ETFs directly from the investment company or from iShares in this case. Unlike mutual funds that actually you can buy directly from the investment company. So in this case, you need to have an account with an online broker or with an online trading platform. Here in the UK, I could go to Interactive Investor and go and find the ticker symbol for the ETF that I'm interested in. In this case, the ECAR, and as you can see here, it is available on this online broker. You can see here the symbol LSE colon ECAR. That means that it is being traded on the London Stock Exchange. And here basically I can simply create an account and buy shares from this ETF. One last recommendation: even though you can use ETFs as a frequent trading instrument and buy and sell ETFs on a daily basis if you want to, the best strategy to minimize risk and guarantee returns is to invest for the long term in a solid index ETF with low cost and maintenance fees. And that's it for now, guys. Thank you so much for watching. Please don't forget to like and subscribe, and I look forward to seeing you in my next video. Take care.